Hey guys, the market always moves by hunting liquidity, and if you don't understand how it works, you will probably end up becoming that liquidity. That's why learning about liquidity is so important. So in this video, we'll explain what liquidity really is in technical analysis, why we mark it on the chart, where key liquidity areas form, and how liquidity grab patterns play out. Finally, we'll see how market makers build their models around these areas, so you can start viewing the market the way smart money does. If that sounds interesting to you, make sure to hit the like button to show your support, and subscribe if you're new. So what is liquidity? Imagine you have a food truck with a lot of burgers to sell, but you're parked in the middle of nowhere. You wouldn't be able to sell many burgers in that location. To sell them, you'd need to move to a busy spot where hungry buyers are waiting. That busy spot is your liquidity area. In financial markets, it's the same idea. If smart money wants to sell an asset, they need a large number of buyers in the market. So the price is first drawn to liquidity areas, and after sweeping those areas, it makes the major moves. That's how liquidity works. In technical analysis, liquidity is an area on the chart where many pending orders and stop losses are placed. Imagine if this is our recent price action. If the price pulls back to this support area, many traders see it as a buying opportunity because it has acted as both support and resistance recently, making it a strong market structure level that can push the price higher. But smart money sees it as an opportunity to collect liquidity. If they want to buy this asset, they need sellers in the market. In other words, they need liquidity. When retail traders enter at this level, they usually place their stop losses just below it. Smart money hunts these stops to gather liquidity to fill their own buying orders. In another example, imagine smart money wants to sell this pair. To do that, they need liquidity to fill their large orders. So, where is the liquidity? Liquidity exists where retail traders enter the market. Here, we have an area of resistance that has rejected the price multiple times. If the price returns to this zone, many traders will go short, placing their stop losses just above it. This means the liquidity is above the zone. To hunt these stops, smart money needs to push the price higher to trigger the stop losses and fill their orders. Also, when the price breaks above this resistance, many breakout traders will enter the market, expecting the price to continue higher. Their buy orders also become the liquidity smart money needs. Once smart money gathers the required liquidity, the price will drop, trapping retail traders on both sides. Now, we've covered the general idea of liquidity. But the real question is, why should we mark these zones on the chart? Let's look at the main reasons. Number 1. Identifying potential targets for price. The market moves toward liquidity zones because it is required for future movements. So we mark these levels as targets for our trades. For example, if there's a major liquidity zone below the price, the market may push the price there to grab that liquidity. By marking these levels, we can anticipate where the price is likely to go next instead of guessing. Number 2. Avoid getting trapped. We know that manipulation happens around liquidity levels most of the time. By recognizing where these levels are, you can stay on the right side of the market and avoid being caught in false moves. Number 3. Plan trades with higher probability. Once you know where liquidity sits, you can plan entries, exits, and stop losses more strategically. For example, you might wait for the price to sweep liquidity and then enter in the direction of the next move. This gives you a higher chance of success than randomly jumping into the market without context. Now that we have explained what liquidity is, how it works, and why we mark it on the chart, let me show you the key liquidity levels you need to mark. There are many important liquidity zones we highlight on the chart, but let me show you some of the key ones. The first one is swing highs and swing lows. Now, what are swing highs and swing lows? Swings are price turning points where 3 candles form a specific pattern. A swing high is a candle that creates a high, while the candles before and after it have lower highs than the middle candle. Similarly, a swing low is a candle that creates a low, while the candles before and after it have higher lows than the middle candle. These are also called pivot points. Keep in mind, you can also use a 5-candle pivot for a more reliable point. In this example, these are our identifiable swing highs and lows, which we mark as liquidity levels on the chart. The reason is that these points form levels of market structure where traders have previously entered the market. If the price pulls back to these levels, there's a higher chance that traders will place orders again. So the liquidity will build around these levels, and this is where manipulation can happen. So we mark the swing highs and lows as liquidity levels, but only if they are unmitigated. So, let's remove swings that the price has already broken through. Once we remove them, we're left with the active liquidity levels, the ones that still matter. These are the areas where the market is likely to return to collect orders. It's worth mentioning that, in an uptrend, the liquidity below swing lows is more important than the liquidity above swing highs. This is because when the market pulls back, smart money often targets those swing lows to collect sell-side liquidity before pushing the price higher again. These levels act as strong support zones where stops and pending sell orders are clustered, giving the market a chance to fuel the next upward move. Similarly, in a downtrend, the liquidity above swing highs becomes more important, as the market often sweeps these areas to collect buy-side liquidity before continuing lower. The next key liquidity zones are equal highs and equal lows. As the name suggests, equal lows occur when the price forms lows around the same level, and equal highs occur when the price forms highs around the same level. So, what does this mean in terms of price action? Equal lows on the chart are excellent places to look for trading opportunities. Many retail traders expect the price to bounce upward when it reaches this area again, so they enter long positions and place their stop losses just below. This means liquidity exists below the equal lows, and similarly, liquidity exists above the equal highs. The difference between equal highs and lows versus swing points is that more eyes are watching these levels. This means more orders are likely to be placed here, creating a larger amount of liquidity. Number 3. Turning points. Turning points are prices on the chart where the market changed direction after moving in a long-term trend. Traders often see these levels as overbought or oversold, so when the price comes back to them, there's usually a strong reaction. A lot of liquidity builds up there because both retail and big traders are watching these spots. Number 4. Daily highs and lows. Daily highs and lows are important levels on the chart in terms of liquidity. The daily high is the highest price reached during the day, and the daily low is the lowest price. These levels often attract a lot of attention from traders, with many placing their stop-loss orders or pending orders around these areas, making them full of liquidity. Here is a common trading scenario. In the Asian session, price usually moves in a small range, creating clear boundaries. Liquidity builds just above and below those levels. When the London session opens, the price often breaks above the Asian high or below the Asian low to grab that liquidity. After the sweep, the market usually reverses and makes its bigger move for the day. To use this, you can wait for the liquidity grab to happen and then look for a reversal setup in the opposite direction, which often lines up with the real move of the session. Now that we have talked about the key liquidity levels, it's time to understand what happens around these levels and how the liquidity grab pattern works. A bullish liquidity grab pattern happens when the price wicks below a liquidity level or even closes below it, but then quickly returns inside the range. Now, what does this show in terms of price action? It means that the market was reaching for liquidity below the support by triggering stop losses and trapping breakout traders. This is often a strong signal that the market is likely to move in the opposite direction of the liquidity grab. For example, if price sweeps above Asian high during the London opening but then quickly closes back below the level, it shows buyers have been trapped. This gives traders a chance to look for short setups, expecting the price to reverse and move lower. The same logic works for a bearish liquidity grab pattern. A bearish liquidity grab pattern occurs when the price moves above a key liquidity level, triggers stop losses and buy orders, but then quickly reverses and closes back below that level. This shows that buyers have been trapped and selling pressure has taken control, often leading to a move lower. For example, in a clear downtrend, if the market gathers enough liquidity, the next downward movement is likely to occur, creating a short trading opportunity. When a liquidity grab pattern forms at a resistance level, it can be a strong signal that the market is likely to move downward. Now, the liquidity grab pattern is an early reversal sign, but in order to make it more reliable, you can combine it with the change of character. So let me show you how a valid liquidity grab and true reversal happen on the chart. Imagine if the lowest point of this level is where the liquidity exists. So, in a valid liquidity sweep pattern, we want to witness a wick breakthrough at this level and immediately close above the range. Or we can only have one candlestick close below this line, and then the next candle should immediately close back inside the range. Now this is an early sign that we might witness a temporary reversal, at least to this supply level in front of the price. If the price manages to break and close above the recent supply zone, we would have a change of character which confirms that the downtrend is over and a true reversal is coming. So, combining the change of character concept with the liquidity sweep pattern will give us a perfect insight into future movements. Now that we understand liquidity levels and liquidity grab patterns, let's take it one step further and talk about buy-side and sell-side liquidity, and how market makers engineer liquidity. The liquidity above a high or group of highs is called buy-side liquidity, while the liquidity below a low or group of lows represents sell-side liquidity. Now here's the key idea. The market is always moving from one side of liquidity to the other. After sweeping the sell-side liquidity, the price will typically aim for the buy-side liquidity. Once the stops below the lows are taken and liquidity is collected, the market often shifts direction and runs toward the highs to capture the liquidity resting above them. However, sometimes the price consolidates in a range, building liquidity on both sides. Once liquidity is collected from one side, the market often shifts to the opposite side to continue the cycle. This concept is central to what's called the market maker model. The model is based on the idea that smart money creates phases in the market to engineer liquidity. First, they accumulate orders in a range, then push the market in one direction to grab liquidity, and finally reverse it toward the true intended move. The important point is that liquidity pools, both buy-side and sell-side, act like magnets for price. You want to see where these pools are, because price usually moves toward them. If price is going up, it will likely aim for the next buy-side liquidity above. If it's going down, it will likely head toward the next sell-side liquidity below. We use these liquidity levels as targets for our trades, entering before price reaches them, and planning exits around where the next buy-side or sell-side liquidity sits. So guys, that's it for this video. I hope it was helpful for you. If it was, don't forget to give it a like and subscribe to our channel if you're new. And don't forget to share your thoughts in the comments. See you in the next one.